Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Sharon Patton, mortgage broker in Burlington, Ontario.
Your mortgage is up for renewal in 60 days, your separation agreement isn't signed yet, and you just found out the payment you're looking at is nothing like what you and your spouse used to share. What do?
That is exactly the kind of moment where people freeze, and it's exactly the kind of moment where the wrong move costs real money.
So let's talk about what Sharon Patton, mortgage broker in Burlington, sees when clients come to her in that situation. Because it happens more than most people realize.
And the thing is, it's not just the renewal pressure. It's that the whole mortgage question is tangled up in a legal process, an emotional process, and a financial process all running at the same time.
Someone came to Sharon Patton recently who was in that exact spot. The family home had good equity, both partners wanted to stay in Burlington to keep the kids close to their schools, and the question on the table was whether one of them could carry the mortgage alone.
And that is the core question in almost every divorce and separation mortgage file. Not, what's the rate, but, can one person qualify for what two people used to carry together?
That's a fundamentally different problem than a standard mortgage application, and it requires a different approach from the start.
Right, and here's where the standard process fails people. Most lenders and even a lot of brokers treat a separation file like a regular refinance with extra paperwork.
But it's not that.
It's not. The mortgage decision in a separation is tied to a legal process, not a market decision. That changes everything about how the file needs to be structured.
Sharon Patton is specific about this. Divorce and separation mortgages involve a distinct set of rules, timelines, and documentation that most lenders are simply not set up to handle well.
The stress test is a good example of where people get caught off guard. The qualifying partner has to demonstrate they can carry the mortgage at the federally mandated qualifying rate, not the rate on their offer.
And that threshold doesn't move, regardless of how cooperative the separation is.
So if you've already negotiated a buyout price with your spouse and then you discover you can't qualify at the stress test rate, you're in a very difficult position, with a signed agreement.
That's the scenario Sharon Patton works to prevent. The pre-qualification needs to happen before the agreement is finalized, not after.
And the separation agreement itself is not a background document in this process. Lenders read it as a primary underwriting document.
What are they looking for specifically?
3 things. Who is responsible for the existing mortgage, how the property is being divided, and what support payments are in place. If any of those are missing or vague, the file goes on hold.
And that hold can push a closing date back by weeks.
The most common problem Sharon Patton sees is vague property language. Something like, the matrimonial home will be dealt with at a later date. That gives a lender nothing to work with.
The agreement needs to say who is buying out whom, at what value, and by what date.
And it needs to address what happens to the mortgage itself, whether it's being assumed, discharged, or ported.
Which brings us to the support income piece, because that's where a lot of people assume they're disqualified when they might not be.
Child support and spousal support can be used as qualifying income, but the lender needs to see the signed agreement, the payment history, and confirmation the payments are ongoing.
A verbal arrangement doesn't count.
And there's a borrowing power impact on the paying side too. For every $500 a month in support payments, a borrower can lose roughly $100,000 in mortgage borrowing power.
That dynamic affects both partners, and it needs to be factored into the qualification picture before the agreement is finalized, not discovered afterward.
This is exactly why Sharon Patton emphasizes working with a lawyer and a mortgage broker in parallel, not sequentially. When the broker knows what the lender needs in the agreement, that information goes to the lawyer before it's signed.
That coordination is what saves time and protects both partners from signing something that creates a mortgage problem they didn't see coming.
Let's talk about the equity side of a spousal buyout, because there's a ceiling that surprises people.
The loan-to-value limit.
Right. In a standard refinance, lenders apply a loan-to-value limit on how much of the home's appraised value you can access. In a spousal buyout under CMHC's refinance guidelines, that same limit applies.
So if the remaining partner needs more than that ceiling to pay out the departing partner's equity share, the numbers may not work through a conventional lender.
And understanding that sealing before negotiations begin protects both parties. You don't want to agree to an equity split that the mortgage math can't actually deliver.
Sharon Patton, as a mortgage broker in Burlington working in this niche, runs those numbers early, so the agreement reflects what's actually achievable.
There's also the prepayment penalty question. If the existing mortgage has a fixed term, breaking it to complete the buyout can be costly.
And in some cases it makes more sense to port the existing mortgage into the buyout rather than break it.
But that depends on the lender's portability rules and the new mortgage amount, decisions that need to be made before the separation agreement is finalized.
Let's talk about renewal timing, because that's the pressure point a lot of people don't see coming.
If your mortgage is coming up for renewal while your separation is still in progress, you're facing two major decisions at the same time and they interact with each other in ways that aren't obvious.
But renewal is also an opportunity. It's a natural exit point from the current mortgage contract, and it's often the lowest cost moment to restructure.
If a buyout is planned, coordinating it with the renewal date eliminates the prepayment penalty that would otherwise apply to breaking the mortgage mid-term.
That alone can reduce conflict between partners over who absorbs the penalty cost, and it preserves more of the shared equity for both of them.
Sharon Patton describes mortgage refinances structured around a renewal date as one of the most effective tools available to separating couples in Burlington, and one of the most underused.
There's also the term length question: lock in now or wait?
And Sharon Patton's answer is that the rate decision and the buyout decision shouldn't be made in isolation. If your separation agreement is close to being finalized, waiting for a rate movement you can't predict may cost more in delays than any rate difference would save.
And if your situation is still evolving, a shorter term offers more flexibility than a longer lock-in.
One regulatory point that's worth knowing: if you're on title for the existing mortgage, you remain legally responsible for that mortgage until the lender formally releases you.
A separation agreement between you and your spouse does not release you from the mortgage contract with the lender.
That release only happens when the buyout is completed and the title is transferred. Until that point, both partners carry the liability.
Which is one more reason to move through the process efficiently rather than letting it stall.
Now let's talk about the outcome that Sharon Patton says is possible more often than people expect: both partners coming out of the separation as homeowners.
Not just the one who stays in the family home.
The structure is this: the shared home is sold, the equity is divided, and each partner uses their share as a down payment on a new property. The key variable is whether each partner can qualify on their own income.
And in Burlington, where property values mean qualifying on a single income is genuinely challenging, this takes careful planning.
But the equity split, the support payment structure, and how joint debts are allocated in the agreement all affect what each partner can qualify for independently.
So structuring those elements with mortgage qualification in mind, before the agreement is signed, can be the difference between both partners owning and only one of them owning.
A common pattern Sharon Patton sees is both partners wanting to stay in Burlington to maintain proximity to their children's schools. The family home has meaningful equity, enough to give each partner a viable down payment on a more modestly priced property.
And with a larger down payment, the mortgage insurance requirement can drop away, which improves the monthly payment picture significantly.
That outcome is achievable for many separating couples in Burlington when the equity is structured correctly. But it requires the mortgage planning to happen alongside the legal process, not after it.
Let's not skip the credit piece, because it's one of the most practical things a person can do to protect their options. And it gets overlooked when people are focused on the legal and emotional side.
The most common credit risk during a separation is a joint mortgage or joint debt that one partner stops paying. If your name is on it, you're equally responsible in the eyes of the lender, regardless of what the separation agreement says about who's supposed to pay it.
A missed payment on a joint account affects both credit files. And a damaged credit score can disqualify you from a mortgage at exactly the moment you need one.
Research from Equifax Canada shows that a single missed mortgage payment can reduce a credit score by 60 to 110 points. Enough to push a borrower below a lender's minimum threshold.
Sharon Patton's practical advice is to get a copy of your credit report early in the process so you know exactly what joint obligations exist, and then work through the separation agreement to ensure each one is addressed with clear payment responsibility.
The debt-to-income ratio matters too. If your share of joint debts is pushing the gross debt service or total debt service ratio above the lender's threshold, your qualification ceiling drops.
Reducing or eliminating joint debt before applying for a buyout or a new mortgage improves your position, and doing it early gives you time to course correct if needed.
So when you pull all of this together, the stress test, the separation agreement language, the support income documentation, the renewal timing, the equity ceiling, the credit profile, it's a lot of moving parts.
And the through line in everything Sharon Patton does as a mortgage broker in Burlington is that the planning has to happen before the agreement is signed, not after.
When both partners know what they can qualify for before the agreement is finalized, the negotiation is more grounded and the outcome is more stable, for everyone, including the children.
A spousal buyout typically takes between 30 and 90 days from the time all documentation is in place. The most common source of delay is the separation agreement itself, either not yet finalized or not specific enough for the lender to work with.
That timeline compresses significantly when the mortgage planning and the legal process happen in parallel. That's the coordination Sharon Patton brings to every file.
The lesson here is broader than any one scenario. The families who come out of a separation in the strongest financial position are the ones who treated the mortgage as part of the legal process, not a problem to solve after the papers were signed.
If you're going through a separation in Burlington or the surrounding Halton region, Sharon Patton is the person to call before your agreement is finalized, not after.
Sharon Patton is a mortgage broker in Burlington specializing in divorce and separation mortgages.